Hi, I'm Taylor, and let's talk about how to build a model for a management company of a venture capital fund. Now, the key thing to remember is that the fund and the management company are two separate business entities. The fund is the entity that makes all the investments and hopefully gets proceeds from the proceeds and investments back. And then the management company is the business entity that manages the funds. Now, the management company actually operates a lot like most companies. It has revenues and expenses. The key is the revenues are the management fees from the fund, and the expenses are normal business operating expenses. The primary expenses are salaries, really, people. So partners, principals, analysts, associates, operations team, whatever staff you have that's staffing the fund and your broader strategy in terms of sourcing, investing, and supporting portfolio companies. It's mainly those people who are going to be the primary set of expenses. And the other expenses are going to be, other things around travel or marketing or taxes or annual business filings or software necessary to operate, those sort of things. Another thing to remember is the management company can manage multiple funds. So if you raise a fund one, you're going to establish the management company in fund one, and then if you raise a fund two, well, you still have the same management company that's going to manage both funds, and you can continue to add more investment entities on top of that. Now, for most of the models I have, all the free models I have don't include like a sheet to model the management company, but honestly, it's easy to add it in. It can be like a one-sheet model to model the management company. In a few of the models, though, I do have a sheet pre-built, and it looks something like this. So usually, the focus on it is pretty simple. It's revenues at the top, and then expenses. Now, this one, and the models that have a sheet like this line for management fees is an input from the fund's forecast of management fees. So I can just add in a little example here to kind of show you how that part would work. Let's just say fund committed capital, and then let's just do management fees as percentage of. Now, obviously, it doesn't always have to be off committed capital. Sometimes you can charge it off of called capital or assets under management. So there are different other ways to do that. If necessary, do that. And if you do that, you have to have a little more detail to how you're thinking about the operations and the proceeds and distribution to model like the actual amount of invested capital as part of the fund. So it needs a little more fidelity to your forecast to be able to do that. But if you're basing off committed capital, it's usually pretty straightforward. Let's just assume that the fund is, let's assume it's a $25 million fund, for example. And we're just going to assume that it pays 2% per year for 10 years. You could also change this. Like, you could make it not uncommon to make it 2.5% for the earlier years and then phase it down over time period as the activities in terms of investing goes down. It's also not uncommon to have it committed capital for the first 4 or 5 years, and then have it switch to assets under management for the time period after that. So there's different ways to structure it. But the key thing I just want to show you is how the operation works in terms of how to think about the revenues for the management company. So I'm just going to now do this. And now you usually get something like this. Now, you could extend the fund to multiple years beyond that. Typically, you don't have fees for extra years unless the limited partnership agreement kind of specifies that. So typically you have revenues like this, which is just the management fees, which is usually pretty consistent throughout the lifetime of the fund's operations. I have a TBD line there just like captures anything else. Sometimes the fund has other additional sources of revenues, but the fact is, like, oftentimes if the management company does have other sources of revenues, there's oftentimes like offsets, like fund offsets that they'll offset against the management fees as part of the LPA. So, I'm just assuming it's all zero for right now. And in most majority cases, management fees are the primary source of income. So expenses, there's a few different ways to do it. All this is just blank lines, right? And this is why forecasting for management company can be pretty straightforward. So oftentimes we're going to do, I'm going to take these ones and move these ones down. Probably a partner. And let's just say and then there'll be some, and then I'm just going to take these and phase them across. during the time period. And then other expenses are what you expect. Like, so whatever you're paying for general liability business insurance, whatever you're paying for like key man insurance, whatever you're paying for annual LLC filings or whatever business filings are associated with the entity, whether there are marketing costs you're paying, travel costs, those sort of things. Now, one thing that comes up all the time around this is like what expenses are charged to the fund versus what expenses are charged to the management company. In general, the way I think about it is the expenses, there are additional expenses that are charged to the fund on top of management fees. Fund administration, fund back office, fund audit, tax, accounting. Those are things that the management company is not going to pay, but the management company will organize that and will charge it to the fund for the fund's operations on top of management fees. So the management company itself will have accounting and tax and those things, but it's only things those things associated with the tax and administration for the management company itself, which often is a lot simpler and more straightforward than what's required for funds. Now, a couple of things to think about. One, the important thing about it is like budgeting for cash. Typically, management fees, definitely for small funds, can really limit the size of the operations of the company. And so you have to think about in terms of like what salaries are appropriate to pay during the time period. I have a little thing in here in cash, which basically brings in like how much cash the management company has, revenues, expenses over that time period. I have a line for external funding. Sometimes, the management fees aren't enough to cover the expenses, especially early on for small funds, and may need to have external funding for the partners who are going to come in to fund it. It's possible. That maybe pay back later, but that can come from that. And I have a couple lines here for carried interest. Now, carried interest typically isn't something that's like budgeted to pay for the operations of the fund. It's typically comes into the fund like once the management company has earned carried interest based on the performance of the fund, then they'll get carried interest payments in, and then disperse them to the various parties according to whatever the agreements are with the general partners or the employees, the staff, whatever share of the carry they get essentially. So, I don't typically do that like a model like this. I'll focus on like budgeting for the cash flows of the management company to make sure like we understand like, what can we do or what the operations of the management company have to be based upon the management fees of the fund. But sometimes we do add in a couple extra set of lines here, which will then show for carried interest when it's coming in. And typically this forecasted carried interest is going to come from the fund. Then we'll have lines for the individual people and their share of the carry and show the disbursements of carry to them. But I treat it as kind of as like a pass through. Oftentimes funds actually do have a dual vehicle structure to separate kind of fees and expenses and carry and those things. So there can be, in some cases, there's a little bit more of like a legal wrinkle in terms of how the cash flows flow. But from a budgeting, from a pure cash flow perspective and thinking about like expenses to the management company, the legal structure is less important for that part. One that often comes up is what about expenses like in later on, especially if you have charging assets under management, or you're decreasing the fees during this time period. The fees here will be a lot less. Sometimes you'll run a thing where you run cash flow positive and then you start running cash flow negative in later years. And that's often because you'll have either the fees have gotten reduced or they're declined, and the expenses stay the same or increased. So there's two things about that. One, that doesn't actually happen usually. Like if the management company raises an additional fund, then you just have an additional fund. Right, you basically stack another set of management fees on here. So you'd have management fees from fund 1, and then you'd have management fees fund 2, and hopefully management fees fund 3. And to some degree, like the operations of the fund will increase, but not quite at the same rate in terms of revenues. And so you can tend to stack fees and increase compensation for staff as a part of that, or pay for more growth or more venture partners or other areas to kind of help support the portfolio essentially. So it's also possible to build out the way we have a schedule for this. Maybe we'll do another forecast for another set of fund. Maybe we'll do the same thing, for example, and we'll say like maybe this is fund 2, and maybe this doesn't come in until year 4, for example. And so then we'll do. So we'll do something like this, and then fund 2 comes in as, it's not really, it's a little, there's cleaner ways to do it, but I want to just kind of show how it works. But you can have fees layer on top of themselves. Now this works a little different for rolling funds, because each quarter is its own fund entity, and so you have fees rolling slightly different. They roll in, they get accrued, and they get paid back kind of from the angels whatever time. So there's a little more complexity into that, but in general, from like most closed-end funds, it works kind of like this. You see the funds kind of stack on top of each other, and that's why if you're just modeling this for one fund and you see a decrease in cash on a management company in later years, it's usually because you haven't modeled out fund two. And if there isn't a fund two, if you're not going to raise a fund two, well, then you're going to stop employing the people and the costs and things to kind of run the entity, and so the cost will go down at that period of time. So it's less the any forecast you create with negative expenses later periods. I would worry less about that because it's probably not going to happen. But this is the core part to building a model for a management company. If you have questions about this, ask anytime. Thanks.